Into it. Market performance or lack of performance, more accurately?
We were hit with a double whammy today. We originally opened up with a loss, and that was on the back of a weak US lead. We saw data in the US disappointing. In fact, retail sales down by 0.4%, and we also saw preliminary sentiment, which was down lower in April, and then, of course, the China numbers, which really gave that second punch to the Aussie share market. Now, it was interesting to watch performance because we were sold off after those China numbers came out, but then we saw recovery. And that really points to some forced selling, especially leveraged positions in the Japanese yen, in the JGBs, Japanese government bonds, commodities, as well as stocks. So it does look like there was some earlier forced selling and then a bit of a recovery later on in the day. But altogether, it was a negative one for the Aussie market. The defensives were the place to be. We did see finishing in the black were the telecom, utilities, property and the financial space. And the large caps were the place to be as well. You wanted to be in the top 20 rather than the small cap index. If we have a look at the top 20 blue chips, yes, they were down 0.7%, nothing compared to the small ordinaries index, which was down by a massive 2.7% on the day. And in fact, if we have a look at the Australian share market versus the small ordinaries is actually giving an early signal of a possible sell-off on the market. We have a look at the two. I've just got the ASX 200 on the top and the small ords down the bottom. And if we just have a look at both of them, you can see that the small odds really started selling off back in March, but that may also be because of the skew that we've seen towards those resource stocks, and we have seen quite a bit of weakness so far. So all in all, not a good day on the Aussie share market, but finishing off the lows, and those China numbers really are delivering that second punch to the Aussie market.
National participation, a lot of talk about Japanese investors getting pushed out of some of their domestic investments, in particular JGBs, and looking for higher return, higher yielding destinations like Australia.
Well, the JGBs have been so volatile, and I guess the view is that with zero interest rate policies in Japan and the US, that money probably looking to find a home in some of the more high yielding areas like in Australia. It is interesting to note that it was those higher yielding areas that did hold up today. We saw the telecom, the utilities, the financial space all finishing in the black. However, we haven't seen a huge surge in terms of volumes on the Aussie share market, which would be a sign of international participation. So it looks like for the time being, a lot of the bulls really still in the Japanese market, where the weakening yen will probably be a positive for the market, as we have seen in the past with the US experience, where we have seen that very weaker US dollar. Good news for US company earnings and good news for the US stock market, which until Friday was hitting all-time record highs. It is interesting to note that we have come off a fairly high base. Over the last 12 months, we've actually seen the Australian market rising 9 out of the last 12 months. So yes, we are seeing a loss on the Aussie share market, but I guess we're also not used to it because it has been such a positive 12 months on the Aussie market.
Julia, on gold as well. Michael obviously made mention of it. The sector down some 10%, led very much by Newcrest, closed down 8.25%. Is it a buying opportunity, or is it just runaway time from gold?
I think it's time to have a bit of a rest with gold, especially the gold stocks on the market. Remember, the gold stocks on the Australian share market have been underperforming the gold price, and there's been a number of factors here, and I think the number one factor is that we have seen cash costs increasing in this area. In fact, over the last 10 years, in terms of gold production, we've actually seen cash costs increase by a massive 250%. Now that compares to copper production, where in the same space of time we've seen cash costs increase by around about 90%. So while we still have seen some very good appreciation in the gold price over the last 10 years, we've seen cash costs rising above and beyond that, and that's really seen an underperformance by gold. Now, added into the mix, we're now seeing a very bearish technical scenario. We're seeing institutions downgrading their gold forecast, record short positions, as well as record liquidations in terms of exchange traded fund selling. Now today we're probably seeing a bit of technical selling, and that's where weakness begets weakness, and we certainly have seen a key technical level being breached in terms of the gold price. So if we have a look at gold prices over the last 5 years, this is what it looks like. This is a key technical level. You can see that we're under it at the moment, and no doubt the large moves is also seeing some forced liquidation as well. So unfortunately, gold not looking good. It's almost looking like a perfect storm at the moment for gold. And it's interesting to note in the ASX 200, the benchmark index, all of the 10 underperformers, the worst losers on the market today, they were all gold stocks, and they all saw a loss of double-digit losses. So some huge losses in that gold space, and unfortunately we are seeing some technical weakness, the technical setup not looking good, expected growth in the US as well as those cash costs having risen more than the appreciation that we've seen in gold price in recent times.
Yeah,